Well, hello and good evening. Welcome to Consider This Program. I am your host, Joe Clark.
And I'm Angie Kinzer.
So happy to have you along. And you may be wondering what in the world you're doing watching a financial education program on your Tuesday evening or whenever you happen to be watching this video. Well, it just so happens that after teaching at Purdue University for 7 years and doing a radio show for 20 years, we combined the two, the financial education and the radio show, to bring you ideas and thoughts about things that may be providing financial regrets in your future, if you will. Events that occur, whether it's the loss of a job, the marriage of a child, what to do with things that are going on in your financial life. We provide checklists and education that you can use as an actionable plan to be able to take out. Now, we're going to ask you to call Angie at some point in time at 800-928-4001. Get signed up for your Next Steps meeting. Angie, it's pretty simple, isn't it?
It is. Give me a call.
And Angie will walk you through the things that you need to be able to bring to be able to come in to see our team. In the meantime, we're going to get ready to have a great show tonight. So glad to have you along. If you've got a question or comment, you can email us at considerthis@yourlifeafterwork.com. Go to our website at yourlifeafterwork.com. Or, of course, give Angie a call at 800-928-4001. Now, on to the show. Well, good evening and welcome to Consider This Program. I am your host, Joe Clark.
And I'm Angie Kinzer.
Happy to have you along. Hey, for those of you who don't remember, yes, this has been a live or a taped radio show for about the last 22 years. We now stream live every Tuesday night from 5 to 6 p.m. Eastern Standard Time. You are welcome to join us if you're online tonight. We greatly appreciate it. We have our very own Grant Sullivan, one of our right hands for certain if you're going to go to battle, from our financial planning team, answering your questions. You can do that on Facebook. I think you can email him directly as well. I'm not positive on that. I don't know how you get him the questions, actually. I'm going to have to learn that.
I think it's on Facebook.
Facebook's for sure, but not everybody uses Facebook. Ange, we need another solution. I get to hear that all the time. Anyhow, tonight's theme is myths and mysteries. Angie's got an introduction for us and ready to roll.
Yeah, I'm going to give you 5 retirement myths.
Uh-huh.
I'll give you these, and then you choose one to comment on.
Can I phone a friend?
Maybe.
Okay.
Okay, number 1, I'm too young to think about retirement. Myth number 2, as long as you put back 10% a year, you'll have enough for retirement. Number 3, I can depend on Social Security for part of my retirement income. 4, I have to pay for my kids' college first. And 5, the opposite of number 1, I'm too old to get started.
Okay, I like number 1. I like number 5 the best, so I'll go there. I believe everybody who's listening to this program will have Social Security available to them at some point in time. It will probably change in component, just saying. We didn't always have inflation protection. It wasn't always taxed. The more income you have, the more other assets you have, probably the higher it'll be taxed, and a little bit of changes probably inside of inflation or what we call cost of living. But the last one is the biggest problem. Always focus in retirement, Angie, and understanding that the job is to replace your standard of living. So as you age and progress, your job is to save and accumulate more money. That's true regardless of whether you're 20, 40, or 60. Save and accumulate more money. However, when you look at retirement, the more money that you're saving is less money that you're spending, i.e. less money you're using on your standard of living. Your happiness, darling, and when you retire, is based on replacing that standard of living, not replacing on income. So somebody challenged me the other day and said, you really can't retire on $500,000. And I said, you know what it costs to replace Social Security at about $1,800 a month? Is about $500,000. It's a little bit more than that for the average American when you look at life expectancy and longevity. There's a lot of this stuff that I would like to go through with those myths and mysteries, and we know we're going to hit them in the show. There's other things. Don't forget to give Angie a call at 800-928-4001 or go to our website, get signed up for your Next Steps meeting. We'll give you 90 minutes of our time to tell you things you should consider today, things you're going to want to consider in the future, and if we choose to partner together, what FEG will do for you, and we'll put it in writing. Stay tuned. We got a great show coming. Hey, all of you that are out there online, welcome. Grant, I'm happy if you want to put it in the box so Angie can tell us, figure out how to best get you questions. I know Facebook, but it seemed like there was something else as well. For you to be able to get questions, to be able to answer back and forth. For those of you that have joined us, we certainly appreciate it. We are doing our best to make this the best educational program you can have for the world of finance. But it all depends on your questions and the comments I get throughout the course of the week to make sure that they're right for you. So don't forget to send them in. Angie, what's our first topic?
We're going to talk about The Magical Roth IRA.
The Magical Roth IRA.
Yes.
All right, here we go. Well, good morning and welcome back to Consider This Program. I'm your host, Joe Clark.
And I'm Angie Kinzer.
And Angie tells me in the middle of myths and mysteries that we're going to talk about the Magical Roth IRA.
Yes.
So what's so magical about it?
Well, I don't know how. Well, it's magical because everyone wants to have Roth money, right?
Not everyone. There are CPAs that are out there that will tell people that if the return remains the same, it is absolutely immaterial whether you use a Roth or not. Now that, my dear, is a myth and a mystery because it presumes that your tax rate never changes. If you believe your tax rate is going to increase over time, that your asset base is going to increase over time, or that the IRS may take something away like the Magical Roth IRA for people with higher incomes, then I assure you that looking at it as in a lateral move where it's indifferent is not a correct analogy. It's just not when you look at a financial journey.
Okay, well, we think the Roth IRA is magical. But
I very much think it
But
is.
the myth is that some people have been told that they make too much to contribute to a Roth.
Yeah.
And so we're saying maybe you don't have the full story.
Yeah, so there's two different things. Things change, and you need to write that in your journal and keep it. You know, I've got sayings and things that I need to keep with me. Things change are one of those things you need to keep with you. The Roth IRA was created in 1997, effective January 1 of 1998, where you had a limit on the amount you could contribute based on income. That was $160,000 at the time. AGI, married filing jointly. The second thing was actually whether you could convert or not, and that was $100,000. And the $100,000 included the amount that you were going to convert, right? So people had that in their minds that, well, you could only put in like $2,000 a year. You know, it didn't really matter. Wall Street doesn't want $2,000 a year contributions. By the early 2000s, we even had Roth 401ks that were allowing people, regardless of adjusted gross income, to be able to contribute up to the maximum amount. So I'm over 50 years old, so I can put in $25,000, $26,000 this year into my 401k as a Roth contribution. Should I choose to do it, I pay all the taxes today, but I never have to pay the taxes on the withdrawal. Now, again, part of the mystery, are there people out there that, they're going to get you. Part of the people that say that will be included based on your income back in your taxable income. I can't tell you what's going to happen in the future. I can just tell you that that's kind of tough to do. Around 2007, Angie, is when they changed or told us they were going to change to an unlimited amount of income starting in 2010 for the conversion. So there are many people who don't believe they can afford to contribute today. The contribution amount, it's got your adjusted gross income in the 190s, married filing jointly, because of inflation. It's gone from 160 to that. The conversion rate, doesn't matter how much income you have, doesn't matter what age you have. If you have an IRA and you choose to convert to a Roth IRA, you can choose to do that regardless. And then that brings in the baby, our Backdoor Roth IRA, where people are able to use some of the other IRA rules to get around some of the procedural problems with income. And just so you know, people used to challenge me on that and say, Joe, the backdoor is too questionable. It's just, the 2017 tax code made it very, very clear that the backdoor Roth is acceptable. Anybody who has earned income can choose to have a Roth IRA. You just may have to pay a little bit more taxes than what you planned on.
Okay, and just to clarify, because you use those words kind of interchangeably, a conversion and a contribution, two totally different things.
With two separate Cs.
Different qualifications and, okay.
Contribution is based on earned income this year. A conversion is based on having an IRA this year or the previous year.
Either way, you can get money into a Roth.
Either way.
What percentage of your portfolio do you suggest?
In a perfect world, I mean, obviously the best money that you can ever have over an extended period of time is the Roth money, because there's no taxation on the growth. You can make changes to buy this stock, to go to that stock, this stock to buy that bond. There's no tax change. There's no tax income recognized on it. So you can make changes without long-term capital gains or dividends. And it's already been taxed, so you don't have to worry about the tax rate changing. So if I had to pick one, it would be Roth money. Where we get with the people that come to see us, and again, most people find us, Angie, in a period of time where they're somewhere between 55 and 64. We take care of a lot of people who are older than that. But most people come to us in that age either 2 years before they get ready to retire or 2 years after, and they realize it was a little more difficult than they thought. So there's that 5-year time span, if you will. And so when we're looking at people that are 55 today or older, them having more than a third of their money in Roth IRAs is kind of difficult to do unless they really started saving in life, right? Ideally, you'd have 30% in a Roth, 30% of your money that was after tax, and no more than 40% of your money that was tax deferred. And then we would spend our time, dedicate our careers at the Financial Enhancement Group to helping reduce that 40% on the tax deferred side. The real challenge is when we have families that come in that have 100% of their money tax deferred. My Purdue professors, my AU professors, where all they had was a 403B for years and years and years, where the only choice was tax deferral. And everybody thought that was a great idea until we sit down and we show them what a financial journey is like as opposed to a 1-year snapshot.
Now, can your children open a Roth, or if your children work, can you contribute to their Roth?
Your children have to have earned income, right? So that's number one. And number two, technically they need to file a tax return. So this made it a whole lot easier with the change in 17 because we don't get deductions for our kids anymore, right? You still list the kids and the Social Security numbers. You get nada for that. You get a larger standard deduction, but no credit there in most cases. There's some, for lower income, there's some credits that come from that, but not for most people. So if I had a child that was 16, 17, 18 years old, and they had earned income from McDonald's or like me delivering a newspaper into Tassel and Corn, and my mom and dad had the money and the inclination, they could have given me money to be able to put into a Roth IRA based on the amount of income that I made detasseling and doing the newspaper route. You have to pay Social Security tax on that money in order to be eligible to do it, right? So you have to have technically W-2 income or a certain type of farm income to be able to be eligible for that to occur. But anytime you can, you should consider doing that with any kid that's at college. That's working. I washed dishes when I was at the university. Anytime you have a kid that's at college, if you have the ability to help support them and put money into a Roth IRA, it is a beautiful thing. It starts the 5-year window for when they can use even the growth in a tax-free manner for the things the IRS says are worthy, i.e. your first home, right? So there's things that are there. Secondly, you can always get your contribution back. It's not subject to a 10% federal penalty for early distribution or any of those things.
Does that include the growth?
No, the growth after 5 years for things that the IRS says is okay. So, Angie, you need to understand this as we are here in the middle of election week. All tax policy is social policy. The reason you can deduct the interest on your car, your house, assuming you're able to itemize, and not your car, is because Congress made a decision years ago that it was a good idea for people to own houses, right? Mm-hmm. With your 529, you can't do this in Indiana, but on a national level in a 529, you can take money out of the 529 to pay down college debt. Now, Indiana decided, nope, you can't do that with the College Choice Program. I think we talked about that last week or the week before. But all tax policy is social policy. And so whatever Congress deems good and the president signs off on is what you're going to be able to use that money for.
Hey, we got a question.
Okay.
If all of my money is tax deferred, does it matter that I create Roth money if I can't convert all of the dollars before I die?
Yes, you certainly want to do it. What you want to have is a choice of pots. I mean, let's not kid ourselves. In the last 3 weeks, the presidential election, Congress, the Senate have all been up and down in terms of who was going to win, how it was going to win, what was happening, whether you're going to have a blue wave, whether Trump was going to be reelected. You had all this craziness that was going on. We do not know how the tax policy is going to be 10 years from now, 5 years from now, let alone 25 years from now. And so we're committed at the Clark household. And what I will promise you, if you come to a Next Steps meeting, what we're committed to doing for you is helping you establish tax diversification. That means as the tax code changes and your life changes and as your needs change, we have alternate choices in terms of where we want to be able to pull out money to make sure you're in the best shape you can be in.
A new question that came in, probably because you mentioned the election. So based on the recent election, what changes can we expect?
Well, so here's the big deal, and I said this in the Market Carver this week, and if you're not signed up for that, you ought to, if you care about those kind of things. The Market Carver is a weekly video we put out, comes out every Thursday morning, and it's based on what we thought happened in the economy or the market, the most important the week before. What I talked about today in for this week's Market Carver that's coming out, and again, it's free. You can go to our website at yourlifeafterwork.com to get it, or call Angie at 800-928-4001. But what I talked about this week is a divided House and Congress makes Wall Street the happiest. And it's for very, very simple reasons. There's less change, right? So what Wall Street doesn't want, what we don't want are surprises, right? So when you have to ask those questions about what does it mean for this, that, or the other thing, the way it's shaped up right now, it will be less changes than what we suspected. We know that the tax code that we currently have that became effective January 1st of 18 sunsets December 31st of 2025. It would be doubtful the president would sign off anything that the Congress and Senate would agree to, President Biden, and assume he wins. When you get through this, that's probably the tax code that we have to deal with. You're not going to see anything but a movement toward the middle if they're going to get anything done. And middle is always good when you're dealing with the populace. If anything came out of this election, it showed you how close we really were to each other, and not as far apart as the media would have you believe.
Real quickly, you mentioned that some of your 401ks, 403bs can have a Roth option. If you don't have one, can your employer get that?
Yeah, the employer plan can always add that in as an option. You can't do it on your own is the problem. Yeah. The employer has to do it. Doesn't cost that much money, if any money. The 401k plans we manage for entire companies all have the Roth option in them, but one, and for some odd reason, the employer didn't want it. Other than that, they all have it. I think it's a very, very important option and part of your arsenal you need to have because, again, there's no income limits. The Magical Roth IRA, folks, you need to learn as much about it as you can. Call Angie, 800-928-4001. We're happy to walk you through it in a next steps meeting. Go to yourlifeafterwork.com to find out more. 800-928-4001. Hey, thanks for the great questions, guys, and keep them coming. It is a crazy world, but when you talk about the expectation of an election, none of us really knows, and there are quite a few people out there who will tell you we still don't even know who the winners are. Obviously, we know we have a runoff coming, but keeping the Senate and the House and the presidential office, if you will, separate is one of the things that's always made Wall Street the happiest, just because you have less changes that take place. What's next, Ange?
We're going to talk about insurance may have you throwing money out the window.
This could be interesting. Go ahead. Well, good morning and welcome back to Consider This Program. I'm your host, Joe Clark.
And I'm Angie Kinzer.
Happy to have you along. Working on myths and mysteries. Angie, this one's about?
This is about insurance and how insurance may have you throwing money out the window.
There is an old expression that I am cash poor and premium rich, meaning that I'm spending way too much money on insurance premiums. Great topic. Certainly a lot of myths and mysteries surrounding the insurance environment. Go ahead.
Well, a lot of times you might be overinsured. And
what does that mean?
Well, sometimes with insurance, I know that that's a product and people can make commissions for selling it to you. So sometimes they can maybe tell you that it's part of your investment strategy and sell you insurance. That's happened to me before.
Yeah.
And they tell you, oh, you have to have this much.
Yep.
And so I guess the older you get and the more you save, the less you...
But I don't know when I hear the word overinsurance, the insurance industry has its own stopgap in that, if you will.
Yeah.
And won't, if I tried to apply for $50 million worth of life insurance, they're not going to let me have it because I'm worth more dead than alive. Right? Mm-hmm. The higher your income, the higher your net worth, the more life insurance you're allowed to have.
Okay.
So you can clearly be premium poor, right? And insurance rich. That happens. But the overinsurance, I think that might be a little bit of a stretch.
How do insurance companies profit?
So it's based on the fact that they know most of us will not die with an insurance policy. They call it permanent insurance. So when you hear the word anything but term, so when it's universal life, whole life, variable life, those are all deemed permanent insurances. The average American who ever buys one will buy more than 5. Last time I saw the stat, it was 7. And most people die without insurance. They cancel the policies because life changes and they get to a point in time where they don't need it. It's why I'm a huge advocate of term insurance. I don't know what the world holds for me and my family 10 years from now, where the tax code's going to be, where the business is going to be. So I tend to buy term insurance policies that last for 10 years.
I know there's a bunch of different kinds, but just what's the difference between term and whole life?
So so first of all, and this is going to confuse some of you, and there's probably some of you out there that want to argue with me, and I'm happy to have that conversation. All life insurance, notice I didn't say any, some, part of. All life insurance is based on what's called annual renewable term, ART for short, annual renewable term.
Okay.
And you're buying life insurance that covers your life for a year, right? Everything else after that is packaging, right? So you can have expensive packages in little boxes. You can have very, very cheap packages in huge boxes, right? Everything else is packaging. So the easiest and most simple component is term. You buy life insurance for annual renewable term. Every year you get older. Thus, the cost of your life insurance goes up gradually until you get into your 50s and 60s and 70s. And then it's more of a rapid ascent, if you will, up the price line. There's 10-year, that's what I tend to buy, 10-year level term, which simply means for the first 10 years, your price is going to remain consistent. So you have a better chance of budgeting. A lot of people, mistakenly in my opinion, buy 20-year term. You pay a little bit more for it than you do for a 10-year policy. However, you're going to have that price for 20 years. I've got no clue what my life looks like 20 years from today, right? I don't really for 10, but I buy it at 10 years at a time, and then I tend to replace it every 3 to 5 years, right? So then there are companies that want to sell you those policies that you're talking about that mix in cash value type things. So the old granddaddy is whole life. And then from there, you get into some of the variables and universal lives and other things. But those are ones that have a cash element that are attached to it.
What are riders, and should you steer clear of complicated ones?
Well, I don't know what complicated means. In the annuity world, I would tell you that and annuities can only be issued by life insurance companies. So when I put them together, don't think I'm trying to pick on one versus the other. Life insurance and annuities are the offset of one another. With life insurance, the risk to a life insurance company, if I sell you life insurance, Angie, what is the risk to the insurance company?
That I would die?
You die too soon.
Okay.
Die sooner than expected. So on an annuity, which was really designed to pay you income for life, what is the risk? That you live too long, right?
Yes.
That I'm paying you when you're 116 and you're, you're walking down the store in your little slippers, right? And I'm still going to send you a check. And so the way life insurance companies mitigate that risk is by when they sell too many annuities, which has happened to a large extent here lately, they then sell life insurance to be able to go against it.
When does it make sense to reduce your life insurance?
When life changes. So there's 2 reasons I teach the planning team to have life insurance, and only 2. One is the replacement of income, right? So a lot of the beliefs and things that we have in our mindset came from years and years and decades ago, right? So, back in the 50s, the value of your house was a lot more than 1 year's worth of income, right? Today, the majority of people that I take care of have their houses paid for or are close to having them paid for, and their incomes were many times 1 or 2 times more than what their house was worth, right? It depends what kind of house you live in, obviously, and what your age is in doing that. So to me, life insurance is about, 1, replacing income. If something were to happen to me, to make sure that Barb has a check that's coming in. And then the second one's liquidity. If something happened to you and other people have to be taken care of or other conditions have to be met, I have 4 partners at the Financial Enhancement Group, right? If something happens to me, they've got to buy part of my shares from Barb, so they have insurance on my life so that they can give Barb a check and have greater ownership of the Financial Enhancement Group, which just makes sense. But those are the 2 reasons. As state tax codes change, we watched that happen between the changes in 2000 to 2006, 7, and then again in 2016. When we watch some of those changes really take place, the amount of life insurance that somebody needed, if they didn't need it for estate taxes, really went down. Now, again, part of the complication is that sunsetting tax code, at the end of 2025, where we don't know what estate taxes will be in 2026. So it's really hard to answer.
We got a question. Is long-term care insurance a good option?
I can never tell anybody, nor would I, that if you had long-term care to get rid of it. I will tell you there were a lot of errors made by the insurance companies back in the late 80s, early 90s especially, where policies were sold that just shouldn't have been sold. And what happened is the actuaries, those are the scientists who come up with the numbers, presumed that you would cancel your long-term care policy just like you canceled your life insurance policy. Remember, I told you most people die without one, right? Well, you bought life insurance for Drew and Ava, right? You buy long-term care for you, right? You ain't canceling something you care about, right? But the life insurance, it's out of here, right? You may keep it for your grandbaby, but it's the rest of them, heck with that noise, right? And that's the attitude that we tend to have. So the insurance companies are a whole lot smarter now. But the long-term care policies that were written in the 90s and late 80s were just, there's no way they would have ever, that they should have ever been able to get away with writing them as poorly as they did. And it's put a lot of companies, you can look at the balance sheet of some major companies that actually is running huge negatives. And it's because of their liability that they have against some of these long-term care contracts. I would not encourage a person to go out and buy a long-term health contract from a health insurance company. If you have the right asset mix and it really is something that concerns you, there are life insurance policies where they can't change your premium that have part of those benefits attached to it. Again, that's some of that complex rider stuff that you talked about. But if I were to go buy long-term care, it would be through a life insurance company, not through a health insurance company.
So if you knew for sure you were going to a nursing home, isn't there some kind of hybrid thing?
Well, that's life insurance. So when you talk about a hybrid simply means you do multiple things, right? Okay. So that's where that comes from. It's called a hybrid life insurance policy because it'll cover a death benefit or a long-term care cost.
And all of that seems so confusing because you've always heard people say, they have to be careful of income here or there because if they were to be put in a nursing home, they'll go back and find. And so it must be really expensive.
Long-term care cost can be very expensive, and this is going to surprise people probably. I think long-term care costs really need to be broken into three costs now. Long-term care for those people that are really aged and have no family, home health care, and people that need mental care, right? The dementia, the Alzheimer's. I expect to see the mental care units become more and more expensive as they try to figure out better and better ways, and more of us are progressing there, which is why you're seeing more and more research done on Alzheimer's and dementia and those type of things to slow it down. More and more of us are going to try to go to home health care, and it's difficult to find people that you want in your house taking care of your mom and dad. It's an expensive proposition right now. Those people are dramatically underpaid. And they will have to be paid more. But I think you will see what happens in traditional nursing homes. Those prices don't escalate as much as what you will see home health care. And more people are going to want to stay there. I think we have better technology to change bathrooms and ramps and everything else around. And you'll see that. A lot of us don't need 24-hour care, but we do need dedicated care for a certain period of time every day.
I just wanted to mention one last type of insurance, since we did say that sometimes you can overpay, and this one's more, I think, one that you can forget about, and that is PMI insurance with your mortgage.
Well, that's an unfair comment because PMI has no absolute benefit for you at all. It's a forced coverage that you have to take if you don't have a big enough down payment on a mortgage when you take a house. And we've watched in our lives, Angie, we've watched PMI be assessed if you had less than 20% equity in your home, to not being assessed at all during the 05, 06, 07 era, to now it's back between 10 and 20% depending on the financial institution. But that coverage is only for the bank or the lending institution in case you default. You get nothing for it.
Although with some lenders, it's the burden of the homeowner to go get an appraisal to be able to prove that now they have more than 20% equity in their home.
And they do because they want to continue to collect the premiums, and their liability is reduced. It's a good profit center for them in a lot of different ways. Try not to pay PMI if you can ever afford it. And if you've had a long-term mortgage, it's one of those things you need to apply to have taken off if you were currently paying PMI. Hey, don't forget to call Angie at 800-928-4001. Get signed up for your Next Steps meeting. We look forward to seeing you in the office. We will give you things to consider today, things you're going to want to consider in the future, And if we choose to partner together, what FEG will do for you, and we'll put it in writing. Again, call Angie at 800-928-4001. We'll be right back. Hey, thanks for the questions, guys. Grant is out there looking for your questions. We will do our best to provide you the answers. I hope you're enjoying the show, and we are certainly having fun. Myths and mysteries. So we're going to try to have a title every week to keep us on track. What is the third conversation?
We're going to talk about one wrong choice during distribution can wreck your retirement.
Yeah. Okay. Well, good morning and welcome back to Consider This Program. I'm your host, Joe Clark.
And I'm Angie Kinzer.
Hey, and don't forget when I say good morning, you're probably listening to us on Saturday morning on the radio. We do stream live, so you can see us in person. I guess it is live in person at 5 o'clock on Tuesday evenings Eastern Standard on Facebook, our website at yourlifeafterwork.com. Happy to have you along. So we're going to talk about a mistake that can wreck your retirement. All right,
During distribution.
So I'm hooked. So let's get our terms here straight. So you go through in your financial journey, and when people ask us what makes FEG so different than most people that are out there, one of the key things that I would tell you is that we're tax savvy, master focused people. We spend a lot of time and energy trying to make sure your tax plan this year is good. Number two is we do our darndest to help get you to use your assets, not hoard them. It's on the opposite side of where Wall Street is. We get paid to manage money. When I get you to spend money, that's less money that we get paid on. It seems like stupid for us to do that, but that is just one of our commitments to helping people inside of that financial journey. Third is, it is a financial journey. We do believe it's not talking about 1 month, 1 year, 1 quarter, 1 election cycle. It is talking about your financial journey and being able to provide that income. So when you started out, once upon a time, you were in what we would call the accumulation mode. You were adding money to your account. Your focus should have been in 2 areas: the percentage of income you were saving. Secondly, was building tax diversification, because you don't know, I don't know, what the future tax code is going to look like 15, 20 years from now. Eventually, what you've saved has added up to be enough that what you're currently adding, and you still should add, but what you're currently adding doesn't match as much as what you've already saved. That's what we call preservation. That's where most of the country is, by the way. And then eventually you will slip into distribution, either by your own design. You decide, I'm going to start using this money, or you let the IRS define it for you. I would prefer it. You get a pick. We maximize your tax journey, making sure you're paying the least amount of taxes in total. But some people wait for the IRS to force their hand. Your 2 focuses, by the way, during distribution are the tax rate you pay on the average dollar you pull out, and the second is the volatility between distribution points. So, Angie, I'm interested in your car wreck. Tell me how this happens.
In my what?
You said we're going to wreck a retirement during distribution.
Okay. So is it better to liquidate one retirement account before dipping into another, or withdrawing, or should you withdraw from both qualified and non-qualified along the way?
Talk about myths and mysteries. So we used to have people who would come in that would have 7 or 8 different accounts because they believed if I had money in different places, I was safer.
Yes.
Right? Not necessarily true. What you end up is owning the same stock in 7 different places. But they had money in 7 different places, and they would take a little bit of money from this account and a little bit of money from this account and a little bit of money from that account. And it had nothing to do with the taxation. It had to do with as long as the account wasn't empty, they still felt psychologically like they had money. That's not the answer either. When we talk about tax diversification, the majority of our families have, I think it's 2.7 accounts. So if there's a husband and wife, there is a probability you have 5.4 accounts. An IRA, a joint account, or what we would call a trust account if you have a trust, and a Roth IRA, right? So you would have that, your husband and your spouse would have that, and then you may only have 1 joint account or 1 trust account, which is why you may only have 5, but you have multiple accounts. Everything starts and ends with your tax return. When you do not pay attention to it, not just this one, but the ones that are coming, you're really missing how some of this stuff looks. And so what we want to do is identify, based on your asset base, either existing mailbox checks or future ones. So what's a mailbox check? It's income that comes in that you don't want to stop, but you can't stop. It's Social Security once you've elected it. It could be a pension, maybe rental income if you own farmland or apartments. But that income comes in and that drives you up those steps in that tax rate. It makes your marginal bracket higher. Then you've got your tax deferred money that you're going to have to pull out at some point in time, again, either by your own design or by the IRS's forced distribution, right? Their defined distribution. So when we look at that over the journey, we want to make sure that we're maximizing your existing tax bracket by taking the right amount of money out each time. So Angie, the correct procedure is taking out enough money to get you to the top of the tax bracket you're always going to be in. And then you want to use a bracket that's either after tax, that could be your trust account or your Roth IRA, to supplement the rest. It is a simple concept, a little harder to put into place, but that's what you have us for, right? I mean, again, if you want to do this on your own, that's your business. If you're looking for a fiduciary, though, that's our business. Our job is to take care of you and to treat your money as if it were our own, and we were in a similar situation. So when we sit down at that Next Steps meeting, part of what Grant or Aaron or Dean or Jamie, part of what they will do is to go through your current situation and say, these are the things you really need to consider today. And here's what you're going to want to consider in the future, because it is a journey. It's not a one-hit wonder. That's your tax return. Your tax journey, your financial journey is a longer-term period of time. Hopefully the longer the better, right? And then at the end of the Next Steps meeting, we'll tell you what FEG will do for you, and we'll put it into writing. If we choose to partner together, that is our contract. That's our promise to you.
Now, I've seen a lecture or two that you have presented, and with Thanksgiving coming up, I had to ask this question. Why do people get so attached to their IRAs or 401ks?
So I started to allude to this earlier because I wrote a 10-page or 10-week series in the Herald Bulletin over whether or not you could retire on $500,000. And somebody said $500,000 was a lot of money. The same day, if not the next morning, somebody said $500,000 isn't anywhere near enough. Number one, when it comes to retirement, folks, it's always about standard of living. It's replacing that. But let's look at an $1,800 Social Security benefit, right? If I was looking at somebody who was 60 to 65 years old right now, I would tell them that you could pull out between 3.5 and 4% of your investment account every year, correctly managed, and not run out of money over your course of life, right? So $1 million is going to translate somewhere to $38,000 to $40,000, right? Cut that in half, you're down to the average Social Security payment in the United States. Folks, it's worth $500,000, right? Now, people will sign up for Social Security early without paying attention to how much income they're foregoing by not putting in a right tax strategy. You want to talk about helping people reduce financial regrets. You ought to see eyeballs roll when we show them the number and what they almost did to themselves by taking Social Security at the wrong period of time based on other assets that they had, right? But when we look at that and you see what it's worth, it's kind of like, I get it, right? So what happens, Angie, over a period of time, when you go to that preservation stage, that account value grows. And, you were saving when you were younger, so you would have a better retirement. Now, you're never quitting the financial enhancement group. You're stuck here forever, right? There's no retirement allowed, right? Right?
Yes.
Okay. Now, I want to make sure we're on the same page here. And you go, I go, right? I'm just saying. All right, no. I told that to April, and it didn't work out. She retired after 20 years. It almost killed me. Anyhow, squirrel, sidebar, right? Anyhow, you're going through this process, and what happens are those account values begin to hit real numbers. And the kids have left home, and it's easier to save, and you've got the standard of living that you wanted. And suddenly it reaches a number. And for all of us, there seems to be a number. It could have been 250,000. It could have been $500,000. It could have been $1 million. But that statement comes in that Wall Street makes me send you. And all of a sudden, our hope and confidence becomes in those numbers on that statement. And I kid people in the lectures and say people would invite the statement to Thanksgiving if they could figure out how. Right? I mean, you become emotionally attached. So when my team or myself sit down with you and tell you that it's okay to spend money out of it, there's some of those gulping. It's hard to go through 40 years of saving and accumulating. I mean, you all did the heavy lifting. You guys sacrificed. You said no to bigger cars, nicer houses, nicer trips. You said no to things so that you would have this baby. And now the idea that we would start to take money out of it intentionally, right? Even when you feel like you don't have to have it, just doesn't resonate with people well. And my point is, listen, especially with tax-deferred money, you are going to have a distribution. It's either going to be designed by you with our help, or it's going to be defined by the IRS. And that's not what we want to have happen. So if we can help you coordinate this journey, not just over a 1-year period of time, where we're moving money from one account to another account, but we're doing that in the most tax efficient manner, where either you get more, your family gets more, or your charity gets more. In either of the 3 cases, the IRS gets less. That is generally what people hire us to do. Right? People talk about the investment returns. We're very, very fortunate and blessed. We manage more than $500 million now at the time of this taping. We're very, very, very thankful for that. But a large part of what I spend my time doing for families is in tax planning and estate planning, working on those legacies. Those are just my 2 natural loves.
Have you had to watch people crash their retirement?
Yeah. I have people who've crashed their retirement and who still work with us, and they, because I have all the notes, where I've told people for decades, you need to do this, or you need to do this, or by the rule changed and we need to do a Roth. I had one guy for 10 years in a row. I would tell him to put money in his Roth account, and he'd go to the accountant, and the accountant would say, if you decide to make this a traditional IRA, here's how much money you could save now. He would come back and say, Joe, pull it out of the Roth and put it here. And sure enough, when he went to retire and he said, why don't I have any Roth any money? I said, well, here's the last 10 years worth of notes. And he goes, yeah, I guess I should have listened. Yeah, it's not that the CPA was wrong. It's a difference of opinion. I will just tell you, focusing on a tax year as opposed to focusing on a long-term strategy in terms of how taxation works is a nest egg for disaster. It is a wreck coming in many people's financial futures. And we spend our time helping people reduce financial regrets to get you around from that. So how does that best happen for you? Well, you can go to our website at yourlifeafterwork.com, get signed up for a next steps meeting, call Angie at 800-928-4001, get signed up for a next steps meeting. In that meeting, in 90 minutes, we will give you things that you need to consider today, things you're going to want to consider in the future, and if we choose to partner together, what FEG will do for you. Go to yourlifeafterwork.com. You'll be able to find more radio shows, more newspaper columns, and more checklists where we can give you things you need to consider. Hey, great questions, guys. Please keep them coming. Happy to have them along.
We did have a question come in,
okay.
But it was for the previous segment.
Okay.
Does FEG do debt counseling?
We do not do debt counseling. And somebody asked me this last week. There used to be a free credit counseling company in downtown. I don't know if they still exist or not. Before the Financial Enhancement Group was created, the name of our company was Landmark, and so people thought we were a collections company because apparently there's one of those, and we would get calls for that all the time. And honestly, that's not the case. We really don't know how to help that well in the debt counseling. That is something that is a very, very focused area, and we certainly have people that can help with some of the basic questions. But the ability to call in and negotiate with creditors and to do that in the right way, not to impact your credit report, to try to get you back on the right track, really is a specialized and focused area. And I would encourage you to work with somebody like that. Be careful. There's some of them that will wrap a bunch of bills together and charge you their very own fee. So you just went from debt counseling to getting more debt in order to be able to do it. And that's not the best strategy either. But thank you for the question. What's next, Ange?
We're going to talk about secrets that Wall Street may not want you to know.
Myths and mysteries.
Yes.
All right. Well, good morning and welcome back to Consider This Program. I am your host, Joe Clark.
And I'm Angie Kinzer.
Happy to have you along. Hey, guys, there are things that you want to watch out for. And many of those things are when you're overpaying for fees and services. I talked about this in a newspaper column this week. You'll be able to find that in the Herald. If you're on our list, it'll actually go out to you in an email sometime next week. You pay sometimes for necessity. You pay sometimes for convenience. And you pay sometimes because you think it will improve your situation. In each of those cases, there are fees and expenses that are attached, and you need to understand what they are and figure out what is right for you and your side. Part of why we have the Next Steps meeting where I say, if we choose to partner together, what we do is not right for everyone, and we're perfectly fine with that. We want families that match us, that match our values, that match our what our processes are, and we're happy to devote the time to be able to help people with that, primarily because just because it's not right for you today doesn't mean it won't be right in the future. We had somebody who came in earlier this year to see us that went to a meeting with us in 2013 rather. 7 years later, but he had something occur in his life over a 7-year period of time where now it was time to be able to sit down with us. So don't think that that's the answer. We truly want to make sure that it matches, but we're going to teach you the fiduciary focus because in many cases right now you're acting as your own fiduciary. And that means we have to treat your money as if it were our money and we were in the same situation. Well, if you're making your own decisions, that's your challenge. That's your task. And so my team will teach you what that means. Fiduciary focus is focusing on risk and volatility, fees and expenses, taxes today and tomorrow, and real return. So this one's all about fees and expenses, both the ones that you know, which again, may be a necessity, could be beneficial, or could be just convenient, right? Fees and expenses. Expenses are many times the things you don't know that go bump in the night. All right, Ange.
Okay, we're going to talk about a mystery here. How does Wall Street really get paid? And the answer might surprise you. They might have some secrets that they don't want us to know.
I would read the article. I think that might give you a good breakdown of that. And you can, if you don't get the Herald Bulletin or you aren't on our email, you can just call Angie at 800-928-4001 and ask for it.
I mean, what exactly is Wall Street? I mean, because
so it literally is a street named Wall.
Yes.
But when you think about Wall Street, when we're talking about that, that's where the transactions are conducted on what we call the New York Stock Exchange. Now, the NASDAQ is actually electronic, but both really do the same things. Mm-hmm. And what they're doing are buying and selling shares of stock. So, and really more than them buying it, more than them buying it is matching you and I together. So you have Microsoft, I have and I want to buy Microsoft. So as Wall Street, as the New York Stock Exchange, in this case the NASDAQ, they're going to make an offering price to you, a bid price, what they will buy Microsoft stock for. And they're going to give me a price that they will sell it to me for. That's the asking price, what they want back. So they buy it temporarily and then hand it off to you. The space between those two transactions is called the spread. And that's how Wall Street gets paid. So everything that Wall Street does or has the ability to impact or encourage has to do with increasing volume. The more shares they can trade, the happier they are. So you went from a period of like 1995 where you averaged 200 million shares of stock a day to a period of time where you're between 2 and 4 billion shares a day. Now, you may be saying, well, Joe, that's because there's so many more companies that are out there. Nope, there's actually less publicly traded companies today than there were in 1995. What's happened is we've been forced to put more information in front of you, and we all have a predisposition to believe that the more information we have, the better decision we can make. So I'm here with Andy and Jen and Levi and Casey, producers of the show, right? The more information I get about this monitor or this iPad, the more I may think I know something, but all you have to do is ask them. I know nothing. An app or water? Right? I know nothing about that. And it doesn't matter how many times I sit down to read about cameras. I spend more money on them than most people ever will because of all of the shows we do. But I can read all day long. I don't have the basis and the knowledge to understand. Right? I can read about my Jeep, which I love dearly. Believe me, I have to ask people all the time, what in the world does that mean? Right? But we send out information to people about their statements, which does nothing but show a value and some names and maybe some CUSIP numbers. And people try to derive information off of data that is already old about what might happen in the future. And Angie, then where we really get into trouble is when we let the short-term news media cycles get into us, where we begin to red R, that's react, as opposed to green R, which will respond accordingly. So when I talk about those fees and expenses, where you have necessity, you have benefits, and you have convenience, A big part of why you pay a fiduciary, a registered investment advisor, is because by definition, we are more green R oriented. I can't, with $500 million and 1,100 plus families that we take care of, I can't just get emotional and react. Right? Everything that we do on our team darn well better be documented and disciplined and repeatable in a system. And that's how we try to build it.
So are statements required?
Yes. And you should always get them, by the way. There is a huge trend to go toward what I call MySpace, registered investment advisory, where you have fiduciaries and away from brokerage shops, the ones that have the same colors and have the same names and a different person sitting on the inside. The trend is leaving that and going to registered investment advisors who are fiduciaries. You need to ask both those questions, by the way. And you need to make sure that they're SEC registered. We've got a couple cases of people in Indianapolis that we found where they're not SEC, they're state registered because of their size, that are doing things that they really shouldn't be doing. But that's neither here nor there. When you're dealing with a large wirehouse or a custodian, if you're dealing directly with TD Ameritrade or someplace like that, you don't really need two statements. One is sufficient. But when you're dealing with a registered investment advisor, which obviously I have a bias, I would tell you that if you knew what my team would do for you and how we function, I believe you would say this is something I want to know more about. It's not necessity, but the benefits, especially when you look at the tax planning and everything else, outweigh, in our opinion, the cost for most families. But when you look at that and you break it down, a registered investment advisor, you need a separate statement from them, and you need one from the custodian. So when I look at my life, my 33 years in the industry, there are 13 people where I can say this person stole money, from families and took money from unsuspecting people. And the only characteristic that all 13 of them had, including Madoff, including Shrinker, the guy that jumped out of the perfectly good airplane in Indianapolis, right? When I look at those 13 people, they all sent one statement. You didn't get a statement from the custodian. So you're going to get a statement in our world from TD Ameritrade and then followed up by another one from the Financial Enhancement Group. Ours are easier to read, in my opinion. I think they're more meaningful because they talk about a financial journey as opposed to just a snapshot in time. But do understand you need both of those just to make sure that they pass the smell test and nobody's doing anything funny.
I mean, does fraud still happen in the industry?
I think fraud from SEC registered people has certainly gone down because the regulation. I mean, the cost of what we have to do with two compliance people in our office, the filings we have to have with the SEC. I think that's gone down. What is picked up is the number of people who are trying to get into your account. And I think there's this belief that bigger is better. One of our core strengths at the Financial Enhancement Group is we know you, right? Whether it's through a Zoom meeting, you've got your dedicated paraplanner, associate advisor, and your lead advisor. We know you. We have notes. We'll have people who call in who try to, well, I'm Angie Kinzer, and here's, that sounds like a pretty deep voice for Angie, right? I'm Angie Kinzer, and here's my social security number and my birthday. Yeah, well, sorry, Charlie, it's going to take more than that, right, to be able to get through. But you have to have somebody who knows you to be able to do that. So no online transactions. That's where we see the majority of the fraud. That and the spoofs, right? We get emails every week where somebody says, hey, I'm in Italy, I'm stuck, I need a passport, please wire, right?
Yes.
And it's kind of like, no, that ain't going to happen.
How do we make sure that our families know exactly, what's inside of how much they're paying for fees or expenses? I mean, because not everybody reads.
Right. Most people don't read. We have a fiduciary liability to make sure that you're paying an appropriate amount of fees and expenses. And that appropriate is a key word. We had a couple exchange traded funds that we used early in the 2020 that we don't use today because an alternative came out that was cheaper, that provided the same type of value or benefit. So we made changes internally to reduce the cost. You may have a $100,000 account or $1 million account, and 10 basis points or 0.1% doesn't sound like a lot of money. When you're dealing with $500+ million, it's a whole lot of money. So our job is to protect you from excessive, unnecessary fees and expenses. So we don't use mutual funds because of the hidden and internal expenses that are inside of them. But in the ETF environment, there are periods of time where it's worth paying a little bit more in a known fee to get a better outcome or a better quality or a less risky quality, if you will, less aggressive.
How much of the trade fees gone?
Trade fees eliminated. That doesn't even exist anymore. So people ask how Wall Street gets paid. Their buildings haven't contracted and they've not laid off their sales force. So it cost me $0 to make a trade. And I was telling Darren on the way to our Lafayette office last week, I had a good friend that we'd taken care of since 2002. Somebody was going to charge him $70-some thousand to make a trade on a couple $1 million worth of Exxon stock. And I said, at that point in time, it was $300 for us to make a trade. And he goes, you can't do it for $300. And I said, I tell you what I'm going to do. I'm going to do it for free. And we've been taking care of him ever since. So do not pay for things that are not necessary, beneficial, unless the convenience is really, really good. But you need to know what that is and you need to break that down. But it's our job as fiduciaries to keep you from paying excess fees and expenses. I mean, that's part of the nature. Hey, you've been listening to Consider This program. You got a question or comment? Give Angie a call at 800-928-4001. Don't forget to get signed up for your Next Steps meeting. It's complimentary. It's 90 minutes. We'll give you things to consider today, things to consider in the future, and if we choose to partner together, what FEG will do for you in the future, and we'll put it in writing. Hey, thanks for the questions, guys. They are good, and it is a challenging environment out there. I don't like talking about fraud, but I also don't want people to be not mindful of the things that are going on. If you missed the show, probably a month ago now, we had an FBI director on, former FBI director, that's what he does, is teaches people how to stay away from fraud and the things we do. And he had some nice things to say about things that we had thought of and done. But it's fraud's tough. Really, really is. All right.
Okay, so our outro. Do you want to pick one of the other myths?
You can remind them again and then remind me what they are, because I'm 53 and it's Tuesday night.
Well, I'll tell you what. We have a question and it'll be a great outro, so we're going to do it.
All right, fine. Go ahead. Well, good morning and welcome back to Consider This program. I am your host, Joe Clark.
And I'm Angie Kinzer.
Happy to have you along. We appreciate all the questions, guys. For those of you watching live, 5 p.m. to 6 p.m. Eastern Standard Time. Appreciate all the questions. Go ahead, Angie.
Okay, we got a question in.
You have this sheepish little grin on your face.
I know. Just because it's so near and dear to my heart, but why do you call them families versus client?
It's a great question. I've done this for 33 years. The average life expectancy for somebody in my industry is 13. There's more people in our industry over 75 than under 35. And quite frankly, majority of what I spend on my life has nothing to do with managing your investments. I've got Adam and I've got Andrew and I've got other people that are able to help and assist in that. Most of my stuff that I do, it requires, and from me at least emotionally, a level of thinking about what I would do for a family. When I think about the word client, I think about somebody who is paying me to do a job, and in all fairness, you are. But I just think about it as family because you do more to take care of and protect families than you do the other. We spend an awful lot of time on redundancies, trying to figure out how to navigate COVID. Whether it's funerals or calling to check and see how somebody did at a hospital, things that a lot of people do. I'm not saying that we're the only ones that do that. I'm just telling you, for me, that's what it resonates. So, we don't have an FEG employees. We have an FEG team because I think of it that way. If one of them is not supporting the other, they have a short life expectancy. It's not an individual role. It is a team role, and that team is designed to protect our families, the people that we bring in. We don't treat people different over money, and that baffles people all the time. But you can look and see what our procedures are for people that have $2 million accounts versus people that have $500,000 accounts. That's just who we are. It is our nature. It's a great question. It's very personal. It's often disagreed with in terms of how you run a business and what you do, but it's who we are, and I'm not going to change.
No, the only reason I laughed about it is I was kind of tying it to another thing you talk about a lot, which are tiny habits. Mm-hmm. And so just all of us, the whole team, getting into the habit of knowing these are our families.
When you get into core values and understand there are some things that are just non-negotiable, how we treat and care for other people, and internally and externally, is just very, very critical to us. And we do take it very personally. And we take you listening very personally. We appreciate it. The comments, the questions. Give Angie a call, 800-928-4001. As we get into heading into a crazy Thanksgiving, I wish you nothing but the best. Happy anniversary, Barb. Love you. Well, yes, I should have probably said that sooner, but I know Barb's still watching. This is on the 12th. So we do this on Tuesday nights. So 2 days from now. It's always when we have a team meeting. It's always exciting. I'm usually gone. But Barb and I will be married for 33 years. And, you know, I used to tell her it was 27 of my best years of my life. But, you know, she's kind of moved up the
Barb,
up the
you're a
totem pole.
saint.
Yeah. You gotta love it. Anyhow, I do love you, honey, and I'm glad I'll actually be home for our anniversary this year. You guys have an outstanding week, and I know as parties are being canceled, and you are able to see my mask that I've got on today, as parties are being canceled for Thanksgiving, just continue to pray for our country, and keep all of you in mind as well. It's a very, very challenging time for a lot of people, but be with our leaders and the science community, and be with our families. Have a great week, my friends. I'll see you again soon.